Perfect.
All right. Well, thank you everyone for joining us this evening. Tonight, we're going to be talking about potential tax law changes based on the Biden administration. Before we hop into things, we're going to go ahead and introduce ourselves if you're new and this is the first time that you've seen us.
So everybody, my name is Jason Matthews. I'm president and CEO of Matthewsfinancial Insurance Solutions. I'm a member of the $1 Million Roundtable, which puts me in the top 1% of financial advisors in the whole entire universe and world. I'm also author of the best-selling book, The Age of Self-Reliance, where I talked about and predicted the next financial crisis, which we are upon us now.
Great. Hello, everyone. My name is Thandiwe Cato, financial advisor at Matthewsfinancial Insurance Solutions. I have a background in banking and finance, and my vision is really to help individuals and businesses reach their wealth potential. So there was a need more so for holistic financial planning, whether it's from managing your money, planning for retirement, or creating generational wealth. So we essentially saw the need to go ahead and fill that gap.
So right now, in January, we had the Biden administration just passed, just got into office. And so what we wanted to talk about was some of the tax changes under the new administration that we could possibly see. And a lot of the data we got from was different plans and proposals that he talked about during his election cycle that's been on his website, and other things that we could possibly be seeing based off the words of President Joe Biden. So let's talk about the first one, the most popular tax code that most people usually hear, which is our ordinary income. So right now, due to the Trump tax cuts, we had our tax rates in America went down to 37%. So right now, the 37% is for people who are single who make over $529,000 or married and make over $620,000 as a couple. What we want to see from Biden administration recommends is that one thing is we do raise ordinary income taxes to 39.6%. Also, he's discussing lowering the top tax bracket for $529,000 to people who make over $400,000 worth of income.
So when it comes to the top rate on long-term capital gains and qualified dividends, so for those of you who are investors, this is maybe something that affects you. So currently the top rate is up to 20% and goes from 0 to 20% based on income. And the new potential tax law change could increase that 20% to 39.6 for taxpayers that are earning more than 1 million and eliminate that step up basis for capital gains tax. So with that 20% that we currently have is for people who earn income of right now it's 441,000. And so that would basically be changed or potentially be changed. And Jason, do you want to go to a little bit more detail about the step up basis for capital gains taxation? That's a huge one as well.
Yeah, I think this is a huge one, especially right now where we're talking about the transfer of wealth with baby boomers getting older and they're passing down the wealth to the children and grandchildren. What is getting proposed right now is eliminating what the step up in basis. And how step up in basis works is, let's say I have a client, this is a perfect example, where their father bought a property years ago for $50,000. Now the property is worth $1.3 million. Now, if he sells it anytime he is living, he will have to pay on the gain between the $50,000 and the $1.3 million. But the day that he dies, his family gets all that growth of that $1.3 million tax-free. What Joe Biden is saying is, you know what? We're going to get rid of that step up basis. And on day one of you getting that property, you're going to have to pay taxes on that property, just like if you got it while he sold it to you while he was living. So I think this is a huge one, especially on the transfer of wealth, where we have to put together some strategies for it. One thing is figure out how we want to pay taxes on the increase of capital gains on the transfer of that wealth. I think we can also see a huge amount of home sales from older generations passing it forward. And I think this is where you have to talk to your estate planning attorney, talk to your insurance agent or provider, because you're going to have some type of need for cash to cover the step up in basis taxes. And the cheapest effective way for getting those dollars is trade pennies in for dollars by buying life insurance for that. And that's what life insurance does for that portion.
No, and I think you make an excellent point of having the estate planning portion of it as well. We don't do that specifically, but to talk to recommended estate planning attorneys to make sure that you're not paying a whole lot of taxes once you're transferring that wealth.
Definitely. The next one is, I think is huge right now, is payroll taxes. So right now, how payroll taxes work is that an employer and employees go half and half on the payroll taxes, which is split 12.4%. And they cap off right now at about $137 and some change. And then they also split the Medicare tax, which pays for Medicare at 2.9%. And if you're self-employed, like millions of Americans or people on this call right now, it is 15.3%. So here's how it's going to do. We're going because of the shortfall of Social Security, where we know that Social Security is going to supposed to be installed by 2030. What Joe Biden wants to do is he wants to fix Social Security. And the way that he plans on doing is, instead of capping off after you make $137,000 and above, you don't pay any more above that. After you make that amount of income into Social Security, he is saying you're going to continue to pay Social Security tax, you and your employer, or if you're self-employed, all the way up to $400,000, which is a huge tax increase for a lot of our people, especially here in the Bay Area, or engineers and tech, who we might make 150, 200,000, and after they hit that 137, don't pay any more taxes. This is a way where they're going to have to see a huge tax increase more and more with the Social Security tax. What are your thoughts about this, Thandiwe?
I think this is definitely going to be huge for small business owners and people who are contractors, because, obviously with this, nobody wants to pay more taxes. So we have to kind of understand how it's going to work and affect that, especially through this administration.
Right. And one last thing I think is going to happen is you're going to see a lot more self-employed people who might be sole props or LLCs looking to becoming S corporations, so they can have more money going through the K1 and then through the salary, for they can avoid the Social Security tax and also the Medicare taxes on the income that they receive.
So as far as itemized deductions and how that's going to change, so the current tax laws that we have in place, taxpayers are entitled to deduct the greater of either the standard deduction or the sum of itemized deductions. So things like mortgage interest, medical expenses, local and property taxes, and also charitable contributions. So what happened is, basically through the Tax Cuts and Jobs Administration in 2017, the standard deduction went from $66,350 to $12,400 for single taxpayers, and then up to $24,800 from $12,700 for married couples. So while this was limiting or eliminating certain itemized deductions, so based on that, the Tax and Job Cut, the potential new changes are going to reinstate the P's limitation for those earnings in excess of $400,000, meaning that before there was a cap, it's going to eliminate that cap that they had on itemized deduction. And the other change that's potentially offered is that the cap on itemized deductions would now be raised to at the 28% when income exceeds $400,000. So now basically the income requirement for that has also going to be lowered.
Yeah, this is going to be huge. I think it's going to be huge for doctors, dentists. I think this is a huge thing if you're a consultant, or an attorney who might not have a lot of normal deductions, or you try to deduct as much as you can. This is going to hurt you a lot with that. Whether you're a high income earner through your consulting or dentistry practice, I think this is going to be huge for you, a huge hit for you.
No, you're definitely right.
So let's talk about my favorite tax code in the books. I love this tax code. So you heard me talking. If you heard me before, you can watch my YouTube channel where I talk about the Trump tax cuts, and small businesses benefit a lot from it. And the reason being was you had an automatic 20% deduction for your business. That is the current law due to the Trump tax cuts. And right now, what they're saying is we're going to phase out or eliminate that 20% cut for everybody, no problem, no matter if you're a service organization, trade, or whatever type of business you have. So that 20%, they're going to eliminate that automatic 20%. So remember, if you made 100,000 with your business, you got a 20% automatic deduction. That is 20 grand of deductions automatically. This potential tax thing is, hey, we're going to get rid of that. So that automatic 20,000 is not going to be there. And I think this is going to be is very shocking for a lot of small business owners. But remember, these are things that they have talked about, but it still has to get through the House and through the Senate. But we do know this. Right now, we have printed $5 trillion last year. We know there was a huge amount of national debt even before that. We know we have to figure out how can we make sure, how can we raise enough revenue to pay for all that money that got printed in the future. And I think we have to say is who are they going to tax? And who are they going to tax is the top 10% in wage earners in America, because those are the people who have the money, and they're going to try to figure out how we can raise our revenue by going after the people who have money. And remember, they say 400,000, but this could be for people to make 250. We don't know how this is going to look like when it's all said and done. We just know these are the what he proposed. It was on his website and things he talked about before for his tax plan.
Yeah, no, you're definitely right. I think just because nothing's set in stone, we don't know if it's going to be the 400,000 or if it could potentially be lower than that. We just know that it's going to be targeted at higher income earners. As far as corporate tax, which we're going to go into, so currently the corporate tax rate is 21%, and there's no corporate alternative minimum tax. And so the potential tax law change would increase the corporate tax from 21% to 28%, and it would implement a new form of the alternative minimum tax by requiring corporations with financial income in excess of 100 million to pay tax of 15% of its income, of financial statement income. So this is huge, especially for not only high income earners, but also corporations that are also bringing in a lot of revenue. So specifically, the alternative minimum tax is targeted to high income earners anyway. So this is going to be a really big thing for corporations because they're going to have to end up paying a lot more in taxes.
Right, definitely. And and we have to remember why we had this corporate tax rate at this level. What we noticed was that most countries' corporate tax rates were a lot higher before the Trump tax cuts. They lowered it because you have companies like Apple and Google and a lot of these major corporations who have money offshore, and they kept it offshore. And what they say is, come here, bring this money over. You only want to have 21%. Bring that money over here now. So what you can see is a lot of corporations like Apple, Google, and all these corporations who have money in Ireland and the Cayman Islands and the Caribbean, all over the world. Hopefully what this do is a couple things. The major one, though, is they'll bring their money over, obviously, and do this before any of the tax law changes happen, which will increase the tax revenue that the federal government has. So we have to remind ourselves we need more tax revenue. We have a Medicare supposed to run out by 2026. We know Social Security is going to run out by 2030. So we have to figure out how to generate more revenue, or we have to cut benefits, or the third thing is that we have to grow our economy. And I remember taxes are to pay for things or stimulate certain parts of the economy by having deductions and credits towards certain things more than others. Perfect example is when we look at mortgages on a home, where we get the home interest deduction.
No, that's okay. That the revenue has to come from somewhere, basically. So right now, as we see, it looks like it's mostly going to be high income earners, and also, like you said, all those companies who have been generating a substantial amount of revenue even through the pandemic, who are now going to have to pay that through taxes.
So let's look at state taxes, right? If you're old, if you're old, rich, and wealthy, you better die before the tax cuts happen. Estate taxes are huge right now. So right now, estate taxes, if you look at inflation, it's a couple could die with $20 million past the wealth and pay in the family pays no taxes before any deductions, strategies, gifting, or anything else. It's a huge rake that estates had. Highly wealthy people. Now, what Biden says is he's going to eliminate that. He's going to go from right now this year we had 10. It's about 10 million per individual, so couples about over $20 million. He's going to decrease the state tax exemption down to 3.5. Now here in California, it's very easy to be 3.5. You can do good with your stock portfolios. We're here in tech. You have a lot of people with stock options and tech and stocks. You can have $1 million property or $2 million in San Francisco or in the North Bay or the Peninsula South Bay here, or even in Southern California. So this is going to help affect a lot of people, but they're going to lower the exemption down to 3.5%. After that, they're going to make it 45% is going to be the taxes on your estate. They're going to decrease the lifetime exemption of gifting to $1 million with the top tax rate of 45%. And any appreciation assets will be taxed at death, regardless of the assets is sold. Now, that is a huge thing. When we talked about earlier, when we talked about step up in basis, that means you're going to have to pay taxes on that appreciation after the person dies. And I feel like a lot of people, farmers are going to be included with, especially farmers or people who are house rich. They're going to have their families going to have liquidity issues or cash issues because you're going to have to pay those taxes as soon as somebody passes away. So when you go down to Fresno, you see the farmers, you smell that bad odor of the cows. Those farmers are very wealthy on their land, but they're very cash poor. So I think we're going to see a lot of transfer of wealth happen, not voluntarily, but because they have to, because they don't have the liquidity or cash. And so I think it's highly important if your family it does not have do not have cash, but might be house poor, which I see a lot in our community, is to figure out strategies now as the talks are happening on what you could do to generate some type of cash liquidity, talk to a family member or what options you could do if you want to keep your assets within your family and in your family and your community like you would like it to be.
No, that's a great point. During the Trump administration, the limitation was that was a big deal, and we're going to see how that's going to affect a lot of people who didn't have the. Not, I wouldn't even necessarily say didn't have the proper estate planning, but based it on the Trump administration, and now have to have that huge transition. So I think just coming up from that again, estate planning is extremely important. So, yeah, these are great points.
Yeah. Now, we heard about all the tax increases for high income earners, people who get quite well for wealth, but I want to really hit you guys on some tax credit. So, everything we said about Joe Biden tax plan, it might have been horrific tax increases. I hate Joe Biden because of tax, but there's some really good credits that we should look at. The first one is he going to expand the child tax credit. So currently, the earned tax credit is $2,000 per child. He said he's going to increase it to $3,600, which means people who are middle income earners have multiple children is really going to benefit from that. And okay, the second thing he's going to do is he's going to expand the child independent care, which means he's going to expand the maximum $8,000 credit for one child to $16,000 for two or more children. Right now, the current maximum of that is $3,000. So it jumps from $3,000 up to $16,000 for the expanded child independent care credit. If you're like me in California, you have children, you know how much it costs to have care for your children. So that $16,000, not deduction, but credit is going to be huge. He also said a new $5,000 credit for informal caregivers. It can be family members or loved ones who does this work unpaid. So grandma now kids watch your kids and you get the deduction. Your cousins, your sisters, your siblings take care of your child. $5,000 credit for them. Also, there is going to be a new $15,000 credit for first-time homebuyers. The key for that is they're trying to get millennials who are known right now for renting off from renting to be homeowners. So they give you a $15,000 tax credit for it. Another thing, they're also going to expand on existing premium tax credit that potentially makes state-sponsored health plans more affordable. So what they want to do is a lot of people talking about the cost of healthcare, even after Obamacare, how healthcare is expensive. He wants to increase the tax credits for it so it can be helpful, more affordable for you, which is a great one. Also, there's going to be a renter credit to reduce rent and utilities to 30% of income for low income earners. So if you're struggling with rent, here they're coming out with plans and credits to help you who are low income earners who are paying over 30% on your rent and utilities. And the last thing, he's going to expand the earned income credit for people over 65 who do not have a qualifying child for tax deductions. And this is a huge thing. After you turn 65, your biggest deduction usually your mortgage and your children are eliminated. What he wants to do is say, hey, I feel bad because you don't have those credits anymore. We want to give you additional credit if you're over 65 to help you out, as we know a lot of seniors might need those. What's your thoughts on some of these credits, T?
I think a huge one is definitely the childcare. I think with the increase of more people who are working from home, but their children are also at home, they need, increased childcare, and I think that's going to be a huge one. And as far as the tax credit for down payments, I mean, I've heard two sides of the coin on that one, in terms of how that's going to affect the housing market and how it may become a lot more oversaturated. And so one thing, especially now as we're starting to see mortgage rates go up, I mean, I don't know how that's going to also affect once we have more people who now have this credit to be able to get more down payment assistance. So there's a lot going on. There's definitely a lot going on.
Yeah, definitely. And once you start really looking at what's happening, especially with home purchase and buying, based off the credits and what we talked about, Eric, it seems like what they're trying to do is almost possibly potentially close the wealth gap of families who might have been done traditionally well with wealth and allow there to be just close the wealth gap and allow more transfer of wealth to other people who might not have been able to purchase property, purchase homes, who might not be able to take advantage or live in certain neighborhoods. I think what they're trying to do is help with the transfer of wealth, so more people in America could be included with it, not just certain families who've been taking advantage of these opportunities, but include everybody with it, which I think is huge. And then, like you said, that the child tax rate is huge right now. I think one reason why we're seeing mortality rates go down in America is less and less people are having children because it's so damn expensive to have kids. My son eating at my house already, and I need some more credit for him. He's hungry all the time. I 12-year-old, I'm hungry. He's growing. Food prices are growing. So this is going to be helpful for me, a lot of other families who tired of seeing their kids eat out of the house and home. So I think this is huge and might stimulate us to have more children in this country, as you always need more and more people to join the workforce. But if you don't have a growing workforce, you're going to have issues. We see it with Japan right now. When you have an older society, they'll have younger people replace it because of mortality. People having births are happening at such a low rate at that country.
No, that's definitely a great point. So I think ultimately it kind of gives a lot more balance, because I know initially we're talking about, okay, what are all these things that are going to be changed, that specifically is looking at high income earners, but I think a lot of the tax credits are going to help middle and low income earners a lot more. So it kind of gives a little bit more balance as well there. So as we kind of start to begin to wrap things up, we always like to make sure that this is a dialogue. If you all have any comments or questions for us based on the presentation, please feel free to put them in the chat and we will be happy to answer them for you. Okay, well, while we're waiting for those questions, I guess one thing, I can pose this to you, Jason, is what do you see, I guess, one benefit and one, I don't want to call it, I guess, challenge that you see based on the potential tax changes that could happen during this administration?
I think right now the challenge is he's gonna have to the opportunity for him to get this through is that he has a Democratic Congress and Senate for the next 2 years. So I think this gives him the opportunity to do it. I think the fight he's gonna have with some of these is you're gonna have big corporation lobbyists and or going to fight a lot of these tax cuts. And I think they're gonna fight it. And I'm not sure how many of them are actually going to get passed on that end. And a lot of the talks that he has talked about for helping out the middle and lower income earners, some of them, if you look at the stimulus package, simply are not just going to happen. The big one was the $15 minimum wage. That's not going to be part of the new stimulus package, which a lot of service workers, fast food restaurant industry employees were looking at, but then that was a win for a lot of the franchisees. And franchises like, hey, I'm glad that didn't go up, especially the small business owner who hiring people. They can't afford to pay $15 an hour, but I think they could have been more creative as far as how they do minimum wage. Maybe they give out additional credits for small business owners who do hire people, or they pay for them for a certain period of time until those people move up from minimum wage to increase. But one question I always ask is, when was minimum wage permanent? When do we make minimum wage permanent? And then my other question is, how do we increase the number of breadwinner jobs that we have in America? And I think those are questions, especially when income's been stagnant so long in this country.
No, I definitely agree, and I think one thing that could have been accounted for more is to um, look at the different states. And minimum wage. If you're from California versus you're somewhere in Alabama, it's different. And I think generalizing it, especially for small business owners, it's difficult. So I definitely understand. And I think one thing is you're never gonna make one person, you're never gonna make everyone happy. So either it's going to be the business owner who's like, I'm really glad that minimum wage didn't go up because now I'm gonna cut down on costs. And then the person who's like, I need this money because I need to support my family or I need to just live. So it's I don't know if it's ever going to be a win-win situation when it comes to that specific topic.
Yeah, and I think we just have to figure out how to increase the number of breadwinner jobs in our country, which is huge. Income's now been stagnant for about 20, 30 years in the country, so it's just something we have to figure out and do.
Right, because inflation kept on going up.
Food prices inflation been happening since COVID like crazy. We see the price of lumber right now has went up drastically, and other goods as well. So we have to figure out how to do inflation, especially now more and more employees pay more for healthcare or come out of pocket now for healthcare. Compared to like in the 70s, 80s, you didn't pay for that, or you didn't have to really worry about saving for retirement, you had a pension. So this is a whole different world where now you're more responsible for your savings, your
Yeah,
healthcare, retirement. So yeah, it's very interesting times.
most definitely. And like we discussed most in the first workshop that we did for the year in terms of how do you protect yourself? How do you have, your savings together? How do you have your insurance together? How do you in an environment where I feel like a lot of people got caught up in specifically just focusing on investment or income, what are the measures that we need to make in case, something like a huge pandemic, has happened for the entire year. So I think that's also an important factor that people have had to look at as they kind of go through the situation through COVID.
Yeah, and with the COVID, what COVID should taught all of us was, was no matter how sexy we can talk about stocks and investment real estate, was that if you didn't have your basics taken care of, you really been in a push. It's been very tight. It's been very hard and a struggle for you. So I think what COVID taught us is like we have to make sure we have our fundamentals covered. We could see the gap without proper healthcare in this country for the haves and haves not. We see what happens when people are struggling to pay the rent and the mortgage because they have a proper amount of money in savings to help them out during this hard time. I know there's stimulus packages, but the fundamental thing is a lot of Americans didn't even have $600 in their savings account just to survive. So that first
Right.
month, while you was waiting for stimulus, it didn't happen. And in the summer after that PPP ran out and unemployment ran out, people were struggling and scrambling there, waiting independent on the government, and the government simply was not there and it's where people wanted them at the time of convenience. So we have to make sure, I don't care how sexy these tech stocks are, this Bitcoin, it doesn't matter. Get your financial house in order would have been a lesson in COVID that we should also learn, and not just get caught up in this craziness on options and GameStop and AMC or whatever else you want to buy.
No, that's an excellent point. As we kind of again are finishing things off, the one question is, as we, this workshop was about taxes, how can you reduce your tax liability? We'd love to hear from you. Typically, for our scheduling appointments, just to do a consultation is $300. If you made it here tonight, we would love to schedule an appointment, and this is our contact information on here. That way, we're able to, like I said, everyone's situation is going to be completely different, and we'd love to meet one-on-one to kind of give you more of a customized view of how you can start to not only plan for to reduce tax liability, but also to be able to make sure you're in the right positioning for 2021. 2020 was a harsh year, and we want to make sure that you succeed in your finances.
Yeah, definitely. And I will tell you this, you don't want to be reactive when all these things happen. You want to be a very proactive state. And we noticed during the COVID with the PPP, the EIDL, unemployment, was the people who had all this stuff in order were able to take advantage of this downturn. So make sure that you're one of these people who are prepared, have your stuff in order to take advantage or to be able to adjust as we keep seeing these changes happen. So definitely want to let you guys definitely remember that.
Yes, and I will share screen.